This trading strategy has been an absolute game changer for us. And today we're going to walk through exactly step by step how we approach this unique strategy. So first things first, let's take a look at the basics. We started on February 1st with a $10,000 account, okay? We're taking a look at all of our trades for the last 3 months. That's February, March, and April. So over the course of that time, we took 36 different positions. So it's a relatively low volume strategy, but it has been effective for us. So if we just look at the closed positions from February, March, and April, we've got $6,600 in profits on a $10,000 account. That's about 20% a month. Our win rate is around 60%. So how does it work? Well, we use an asymmetric risk-reward methodology. We approach the market with the notion that we cannot accurately predict the market path in the near term. Okay, so when we're putting on short-term trades, the goal is to give ourselves opportunities to profit in multiple market scenarios. So the idea is some of our positions may profit if the market goes higher. Some of our positions may profit if the market stays in a neutral zone, and some of our positions may profit if the market sells off. Now, this inherently means that we are going to have some losers. We could actually have below 50% win ratio and still have a profitable strategy. And so let's say we were putting on new positions as of tomorrow. We've had a big run up in the market since last November. We had a pullback during the month of April, and now over the last week or so, we've had a slight bounce. So how do we position ourselves in our portfolio, and how do we choose what to trade? Stick around till the end of the video and we will get to that here in a few minutes. Let me just show you a couple of examples just to illustrate. If you look here, starting on February 1st, we actually took a long position on Google. This was a call debit spread on Google. We had a number of factors pointing to a high probability that Google could continue moving higher. And so this trade actually worked out for us. But on that exact same day, as we were putting that position on, we actually put on a hedge position on the Qs to the downside. We bought a put debit spread on the Qs on February 1st. That cost us about $1,150, and we actually had a complete loss on that trade. That hedge was protecting a number of long positions. So if you come up here and look at a number of different positions that we put on, we had the Google call debit spread. We had a Netflix call debit spread on February 13th. We had a Snow call debit spread on February 6th. A number of other positions in February. All of those were bullish positions, and we needed a way to still allow ourselves opportunity to profit, or at least to hedge and mitigate our losses if the market was going to go against us and sell off. Hence the debit spread hedge on the Qs down here. And so this is just a very simple example of a long-short approach that gave ourselves a higher probability to profit both if the market went up and if the market went lower. So the next thing we do is we assign probabilities. We are data-driven traders, so we take in a lot of data from a lot of different sources to come up with probabilistic scenarios. So for example, what is the probability after this run-up in the market from November to April, pullback that we saw during the month of April, and now this slight bounce over the last couple of weeks? What is the probability, for example, that the market is going to continue higher? Let's say that's a 40% probability. We just keep it simple right now. Let's say a 40% probability that the market goes higher. And this is just as an example. This is not an actual probability that we've calculated, but just to show you the conceptual framework that we use. And let's say also that based on the data, 40% probability that the market sells off from this point forward. That's going to leave us with a 20% probability that the market stays within a flat range over the next month or so. So if this is our probability framework, then this can help us position ourselves and size our positions appropriately within our portfolio. And we actually go further into detail in our Geek University course. We actually discuss a multi-factor model, how you can build your own multi-factor model to quantify the probabilities of whether we are in a bullish, bearish, or neutral market environment. So this basic concept allows us to lay the foundation of our asymmetric risk reward approach. The next key factor to our strategy is position sizing and diversification. This is what kills a lot of traders and investors. They don't size appropriately and they don't diversify. This means you're less likely to get consistent results. So if we just take a look here at our positioning over the last 3 months, you can see we have sized our positions here anywhere from 5 to 10%. You can see most of our positions are somewhere in the 5 to 10% range. We do have a few one-offs, like here's an 18%, this is an $1,800 position in Google, one of our earlier positions at the beginning of February. That is an outlier position, a little bit larger. The bulk of them are between 5 and 10%. Again, if you recall, we said we started with a $10,000 account on February 1st. So we can do this strategy with a $5,000 or $10,000 account, for example. But the position sizing and diversification is not going to go as much in our favor as if we had a larger account. Ideally, your positioning is going to be anywhere from like 1 to 5% on the high end if you have a much larger account size. But for our example here, we're in a $10,000 account, and so we're going to be trying to stick within that 5 to 10%. You don't see any 60% positions or 80% position where we're going all in on a trade. So position sizing is key for the longevity of your account. The next component to that is diversification. We actually diversify our strategy in a number of different ways. One way, which a lot of people don't think about, especially when you're trading options, is by the expiration date. We can stagger our positioning across different expiration dates because we don't know exactly how the market is going to behave in general, let alone by a certain date. So we'll stagger our expiration dates. Like, for example, we had expirations on February 16th, March 1st, March 15th, into April 12th, for example, March 28th. So we were kind of all over the place, staggering our contract expirations at various expiration dates. Another way you can diversify is by your underlying option strategy. For example, we're not trading all long calls or all long puts. We're doing a number of different strategies. We've got call debit spreads. We've got this custom here that was a double diagonal play. We've got butterflies. We've got iron condors. We've got call credit spreads, put debit spreads, etc. Having a number of different types of option strategies allows you to kind of diversify your approach and your risk. And finally, the classic, just diversifying by underlying security. You'll see here we've got positions in Google, gold, Tesla, Netflix, Meta, oil, industrials like Boeing, et cetera, et cetera. So position sizing and diversification is a big key to our trading strategy. Lastly, if you've watched our channel before, you know that one of the key components that we use in our data-driven analysis is gamma exposure. And we actually have a gamma exposure dashboard, which we measure the gamma exposure of various securities in the market. So if you don't know what that is, I'll put a link to our gamma exposure playlist in the description below. But essentially what that's allowing us to do is to measure the level of market interest by using the options market and the sensitivity to prices at those levels. So for example, we can see here that at the 51.25 level, the gamma exposure is the highest on the S&P 500. And so we know at that level, option dealers are going to be very active. We know there's a lot of market participants focused on that level. It also helps us kind of define our supply and demand based on option market positioning. So let's take a look at a few examples. Here we're looking at Tesla. Tesla's currently showing slightly negative gamma exposure on a total gamma basis. And this means that there is just a slight bearish tilt in the Tesla options market. And what do we see down here on our graph? We can see that most of the negative gamma is concentrated at the 180 strike. So we could say if we were looking to add Tesla as a position in our portfolio, we might avoid bullish plays at this point. We might do something like selling call credit spreads. If we're extra bearish and have a number of other data points pointing to more downside for Tesla, we may buy the 180 puts, for example. So there's a number of different ways we can play off of this data, but this gives us a key insight into showing us that the market is positioned bearishly in Tesla specifically. Let's take a look at another example on NVIDIA. Very different picture, positive gamma exposure here, most of it between like the 880 and 900 strike. We've actually been seeing that for about a month or so. Actually, if we just go here to the chart and just take a look at the path that NVIDIA took, you can see there's been quite a bit of volatility over the last several weeks. We were at 900, came all the way down below 800, had a crazy bounce all the way back up. Interestingly enough, throughout that time, the gamma exposure has been still pointing to these big levels between 880 and 900. And so as the market sells off and we see that gamma exposure up here at these higher strikes, we know this could be a high probability setup for another bounce. And we saw several of those opportunities over the last couple of weeks. Let's just take another example on Apple. Apple had a big earnings report just a couple of days ago. And so obviously there was a big gap up. And so let's say we're interested in playing Apple. Let's take a look at the market. Where is everyone trading and how are they positioned on Apple? Well, when we look at the total gamma exposure, we can see Apple is actually very bullish. We can see based on a historical range, Apple is on the extreme end of the bullish side. And so everyone seems to be concentrated at the 185 strike. And so that looks like the target for market participants. We're almost trading there currently. We're at 183.36. That could just tell us, hey, let's put on a neutral position, neutral to slightly positive position on Apple if we wanted to add that to our portfolio. That's one of the main components for choosing our various option strategies and underlying plays that we put into our overall portfolio. Even though we perform a data-driven analysis to choose our positions, we use sizing and diversification as risk management tools. I don't want you guys to lose sight, though, of the underlying notion of the strategy, and that is we have no idea what the market is going to do. We may have our biases. Based on the data, we may assign a 60% probability that the market's going higher, but again, we have no certainty in that. And this is where the idea of portfolio management comes into play. This is why professional money managers and hedge funds use portfolios and build portfolios. Portfolio strategy allows you to increase your probabilities, have more consistent returns, and allows you to better hedge yourself in various market scenarios. And so that's our approach, and we use a data-driven methodology in order to construct that portfolio. So if you guys are interested in learning more about this particular trading strategy approach and our overall methodology, you can go to geeksoffinance.com. You can get access to our gamma exposure dashboard. You can become a member. We also have access to Geek University. This is our 5-hour trading strategy course. You also get access to our community Discord. We have great participation and share a lot of different ideas. You guys definitely don't want to miss that. If you guys want to learn more about how we use gamma exposure, check out our playlist in the description below as well. Thanks so much, everybody, for watching, and we'll see you guys in the next video.